a warmly welcome to everybody. Every time when we meet you as investors, we would like to start with a kind of foil you see here. So when doing new recruitments in Manchester, our first sentence to any new recruits is, "We are different." This is our DNA. This is who we are. There are 12 statements on this foil, and we expect everybody to learn those and understand and live. Learn, understand, and live. So to try to remember them is rather easy. Any employee in Protector will remember all 12 at any time. Please call them at 4 o'clock in the morning, Saturday night, and ask the question, what's the DNA of your company? Everybody should kind of give the statement at any time. It's a bit more difficult to understand what it means, so we are investing a hell of a lot of resources in order to educate our people to understand. So when I have met all employees this morning in Oslo, we will always use 5-10 minutes to walk through different elements of the DNA of the company. And since we created that kind of statement 11 years ago, we have invested a lot of resources during those years in order to gradually create something called culture. When we meet you, you will normally be focused on cost and quality leadership, profitable growth, and top 3 position. How do we deliver according to the long-term targets? And the highlights is that, yes, we are growing in Q1. Yes, it's profitable. Yes, we are doing very well in the new exciting market in UK. I'll of course cover that better later in the presentation. In a short quarter, I think it's fair to say that we are back on track in Denmark. However, it's always kind of you need more quarters to see the realities, because 1 quarter in the insurance industry is far too little in order to be sure. But it's a good element that we have started at least out also with kind of a good quarterly result in the Danish operation. The strong figure on the first foil here is a net combined of 87. However, it is, as always, also linked to a lot of reinsurance income arriving early in the year. So the underlying reality is not as good as it looks like, but we feel confident that this year will end up with a combined ratio according to the previous guiding around 92. And if we can deliver 92 on the combined ratio and at the same time deliver a reasonable return on the investment portfolio, the story continues then. So that's what we are focused in order to deliver. Since our first quarter is slightly better than expected on the volume side, and that what we have learned, especially in UK, the last days, weeks, months or quarter, that's the reason why we are lifting up the kind of guiding slightly from previously 16% volume growth in Norwegian kroner up to 20. I guess, Andreas, it's starting to be a bit cold inside the room. Could you close the window here? And then I continue with the presentation here. So volume guiding up 20 or up to 22 in local currency then. As always, you are warmly welcome to ask questions during the presentation. I'm not quite sure whether the loudspeaker is on or whether it's only my voice traveling in the room. Is it my voice? Sorry, say again? It's on? Yep. Okay. So if you have questions, I repeat the questions. And we will also try to cover some of the questions coming through the web during the presentation at the end of the presentation. If you don't have time to respond to all questions in writing, which is arriving through the net, then we will come back and respond to you asking questions after the presentation and during the day. But feel free to ask any question at any time. Okay, so volume-wise, here is kind of a view as expected and normal. Norway with a low single-digit growth. It could be improving slightly during the next quarters. We do have some contracts in the commercial sector already won, which will arrive in quarter 2 and quarter 3. So I think that Norway will do slightly better than what you see here, while Denmark will be, I think, on a lower level in the quarters to follow. And the question is then related to Sweden and, of course, then UK. So what we know for a fact is that quarter 2 UK will be very, very strong since April the 1st is a big renewal date, and that date has passed. So this is slightly better than what we expected a quarter ago. And the outlook is also kind of slightly better. So the growth story of Protector continues. And there are no sign of a slowdown. The weak element in today's situation or presentation is on the claims side. So we are in the higher end with a claims ratio, both net and gross, around 92. So this is above expectation and not really a strong figure, but we are of the opinion that the underlying reality is somewhat better than what you can see here. There are a bit high level of claims in certain personal lines of business areas in Norway, and still in personal lines of business Denmark, meaning workman's comp. The claims level is still on a high level, while some other products are doing rather well. But our expectation at the moment is that the kind of figures you see here will gradually turn downwards during the next 2-3 quarters, and we think that the visibility is rather acceptable in giving that kind of statement to the market. And of course, starting up with a combined ratio size 87, while yearly target is 92, we have some kind of room for some kind of disappointments also in the next quarters to arrive without necessary ending up higher than 92. So the best judgment on the combined is still 92. However, this figure is in the higher end. Motor claims situation in Norway, rather high. Sweden, very good. On average, acceptable or good. But there are, as always, some kind of volatility. And in Protector, that kind of volatility is mainly not driven by weather, by snow, ice, or rain. It could influence Protector slightly, but we are not a consumer company, so it's not extremely easy to predict the claims ratio development of Protector, only looking at what was the weather really all about. That influences more in the consumer sector than in our sector, our clients, and with our product mix. Any questions on the claim side?
There has been some general attention in the market regarding motor vehicles and claims level there on a general basis. To what extent do you think you're exposed to that, and do you see any change in trends in that segment?
Okay, so the question is related to claims development in the motor area, and some competitors are talking about a potential for increased average size of claims in future, for instance, due to technology development. To fix a car today with sensors, etc., is more expensive than when you fixed a car 5 or 10 years ago. Basically, I think that kind of talk is bullshit. So it's more like a good management statement from a consumer-oriented company trying to educate the market to accept higher prices. And as you know very well, the profitability in the consumer sector in Norway and in Scandinavia is historical good. And what my competitors are trying to do is to communicate, blah, 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 very dangerous, very difficult, weather, storm, flood, and claims increases in motor business. So I don't believe in it. We see no signs of it, and it's good marketing from the big players in the consumer sector. So you should go out there in the market, tell everybody that you should renegotiate your policy in the consumer sector, because there is a lot of room in order to take the prices down. Is it a clear answer?
Absolutely.
Okay.
Could you be a bit more specific on the high claims ratio in Norway?
So we are on motor claims areas. The claims ratio is above 100. Disability insurance above 100. That's not normal. On the other hand, group life has now improved. It was above 100 in 2 or 3 of the quarters last year. Now it's below 90, which in our opinion of that product is rather good. So there is some kind of volatility. In the longer run, you should expect the profitability in the Norwegian market to be slightly worse than what you have seen historically. And the reason why is because the rate pressure in commercial Norway, which is the file we see here, the rate pressure continues. And we are losing market share in some segments in the Norwegian market as we speak. For instance, in the public sector. So we are losing municipalities to our main competitor, KLP, because in our opinion, the rates are now on a too low level. So then we'll walk away. But some volatility, you should really look through it in Norway. It's not really an issue, but in the longer term, you shouldn't expect the very, very profitable business we have had here for many years to continue. So we have been on a combined ratio in that segment, I would say mid-80s, and it's a rather competitive market. It will not continue. So that's kind of a bit more the long-term comment.
But you had no net run-off gains or losses, so you have to pay out a lot in cash. It was unexpected this quarter?
Not really unexpected. So it's not always paid out. So this is also kind of reserves on the claims. Even if the reserves are stable, it doesn't mean that we of course add reserves every quarter, since we are growing in a speed 20%. So reserves are going up, but there are no reserve losses on previous years then. So previous years reserve development is stable, which is good. Of course, more reserves in nominal values is obvious since we are growing. So it's not necessarily linked to exactly the payout level. The payout level is more on a normal level, I would say.
So you have to take more reserves than you perhaps expected?
No. Say again?
No, because the claims ratio is higher than
Yes.
you would expect.
Yep.
And since there's no reserve losses, you had to take higher reserves than you expected when you wrote the volume?
Yes, that's correct. So the claims level in Norway is slightly higher than expected, because claims incurred, they have happened, whether they are paid or not, is on a slightly high level than what we expected. It's a quarter. It's always kind of volatility in some segments in some countries. So we think that the claims development in the shorter run in Norway will improve, but not back to the old days, 2, 3, 4, 5 years ago, but back to the level which is in line with the kind of guiding we have given to the market, which is around 92. So the combined ratio in Norway should end up around 92 at the end of the year. possibly slightly better than 92. Okay, so if I go back again, when talking about the cost ratio, it's nothing new actually. We are cost leader in Europe or in the world. As always, it is good. There are smaller fluctuations, doesn't really matter. And of course, we have 25 people now working full time in Manchester and Finland with close to zero income in Q1. That's called investments for future, but it's not booked as investments. It's not activated on the balance sheet, so it's sunk cost. And now in Q2, you'll see volume arrive. I'll come back to that talking a bit more about. So cost level in Protector, it's still extremely good. There is one element here which is new, and as you know, the claims handling cost in the Nordic area is booked on the claims side. So when we say we have a claims ratio around 90, that includes the claims handling cost. There is only one company in the Nordic area who are delivering claims handling cost to the market. That is the market leader, If. So we know where our competitors are when it comes to efficiency on the claims handling side. It's easy to read figures of If, and basically we know where all others are as well. On this cost area, we are not better than peers. So the claims handling cost level in Protector is more in line with peers or possibly slightly higher. So we do think that we have an efficiency kind of opportunity in that area, but the important element is that you should increase efficiency and at the same time keep the quality level on a high level and not kind of waste money on paying claims you shouldn't pay in that. So there is a balance we have to follow up in that area. What we are saying now is that one of the most important projects we will run for the next 2 to 3 years is to increase efficiency and quality at the same time in the claims handling area. And I would estimate the potential to do 1.5 to 2 percentage points claims handling cost improvement in the next 2 to 3 years. That will influence claims ratio development positively with exact same kind of figure. It's changing routines and processes, it's competence development, and it is what you could call digitalization, meaning using technology more in order to improve processes and efficiency in claims handling. And I know that my competitors are talking a lot about it. It's good for them, and they should possibly continue to talk about it. And Gjensidige has also announced something very new. Have you heard it? On the IT side, what are they doing? The biggest company in the Norwegian market, called Gjensidige, a big market leader in consumer sector, very good company. What are they doing? They are insourcing IT development. Wow! We did that in 2003, a few quarters before we started. So I support Gjensidige. I think it's a good idea. And as you know, we are the only company in the Nordic area that do develop all IT systems internally. All core insurance systems, we develop them internally. And I think that is a good move from Gjensidige, and it could strengthen the competitive position of Gjensidige in the consumer market in future. So a good move, but to us it's a bit late because we have been doing that kind of development for a number of years then. Okay, commercial Norway is, I covered that. Change of ownership, we are on track. Number of open claims is on a historical good level. And we are working as hard as possible in order to try to launch a new technology platform for technical surveyors out there in the market that will, if we succeed in that area, it will improve profitability 2-3 years from now within the area. So you will see no financial signs of that kind of initiatives before at earliest 2019. But it's important that we are taking kind of a long horizon and doing investments in what could improve profitability in 2019 and 2020. There are some challenges, and some of them is coming from the Norwegian Consumer Council, Forbrukerrådet in our own language here in Norway. So they have kind of put a report to the market and challenging the way the real estate market is working in the market, the level of conflicts, etc. And I think it's fair to say that we have responded properly on the kind of initiatives taken from the Consumer Council, and we have created a report, 40 pages report, which will be distributed next week in order to respond to the story told by these people who are basing a story on a few complex claims in the court, not on the tens of thousands of claims that we have done the 13 years we have been in the market. So we know for a fact that the conflict level in these kind of areas in the real estate market is on an acceptable level, and it can and will be improved in future. And that kind of tool here is an important tool in order to increase efficiency and quality on technical surveys in the market. So we are in a dialogue with those who are involved in these kind of discussions, and you shouldn't expect any kind of financial implications. But there is a discussion going on, I would say more or less as always, when it comes to conflict level in real estate areas, where it's, I agree, it's still too high level. It could be improved. The question is how. And we know a lot about it, and we will be heard. And I think that most of the people that can influence the future here will give an ear to Protector and the storytelling we are doing in that area. We are slightly on the profitable side on the product in Q1, and it's expected to improve, as you know very well, from reserve losses last year, especially Q1 and Q2. We have had now 3 stable quarters, basically without any reserve changes. Q3 last year, Q4 last year, and Q1 this year. But we do expect the profitability to improve in the next coming quarters. Everything else equal, that will slightly then improve the combined ratio of the company. Sweden, another very strong quarter. I would say possibly a bit of good luck again in Sweden. So while Norway Motor is too high, motor business in Sweden is very, very good. And Sweden develops very well in many areas. So I think that we have 2 or 3 good years ahead of us with an acceptable possibility for continue the profitable growth story. As we have announced, it is an ongoing investigation from the Swedish Competition Authority. Our opinion is that we can't really understand we have done anything wrong, but we have to wait and see what the authorities do have as a conclusion. It could take a year, and we are, of course, working very closely together with authorities. Extremely open book, give them whatever they like, and if there is something difficult for them to find, we will hand it over anyway. So we have nothing to hide and working closely. And the kind of investigation they are doing also included then that they went into another insurance company in Sweden a couple of days ago in order to look through the processes for negotiating certain contracts, especially in the public sector here. Working closely together with authorities, it will take time. And in the meantime, in Sweden, it is business as usual, and it's absolutely not a situation where we have anything called a bad culture or something like that in Sweden. So the kind of working processes Sweden do follow, they were established before we hired the first person in Sweden. So this is kind of an ongoing practice which the authorities are looking into and has been there for 10, 15 years in the market. So nothing to do with employees of Protector in Sweden. It's very important for me to give that kind of statement to all of you. An element which I normally do not cover talking to you in a quarterly presentation is claims handling in a certain country. But I would like this time, in order to focus a bit more on the claims handling development in Sweden. I think that in many areas Sweden is really a front runner in innovation, increasing efficiency and quality in claims handling. 2.5 years ago, the motor claims handling team in Sweden, they decided themselves to double efficiency from 1,200 claims per full-time employee to 2,400. And the target they set 2.5 years ago was to deliver on average 2,400 claims per year in 2017. And I'm absolutely convinced that we will reach that level in 2017. And the best employee in the motor claims handling area, 2016 in Sweden, it was Marie. Lady, been working in our motor claims handling department since we started the company. She's one of the employees of the year. She was celebrated in New York this weekend. And she was not only one of the employees of the year, she was the employee of the year. So she was number one among equals as the star, the big star. Marie, a grown-up lady, about my age, rather young, you know. So she is the star in the company at the moment. She did 2,700 claims last year. And I think they do have a process in Stockholm now, as we speak, in order to look into 2020. And I'll meet Stockholm on Tuesday morning, and I'm kind of curious to listen to what they have on the agenda, because I know they have started to discuss what kind of future targets will they have on the number of claims per employee in 2020, because they know they have doubled in 2.5 years. So this is the kind of things which is of extremely interest for Protector in order to continue in many areas to improve the value chains we do have, improve efficiency and quality at the same time. And I think that they are very proud in Sweden on being possibly the best entity in Protector when it comes to clean desk. Meaning, when a claims handler do leave at 4 o'clock or whenever they leave in the afternoon to go home and have dinner, they do not have any action which is open and should be delivered and done. So if there is a client response that should have been given during this Friday, you normally see a situation in Sweden when they walk out of the office, they are clean. Then how many of you can say that when leaving Tuesday, Wednesday, Thursday, Friday, or Monday afternoon, when you are leaving your desk, it's clean? You have absolutely no actions which is overdue. So raise your hand. Not too many hands. Me neither. But this is clean desk. And Sweden is very good in claims handling. and improving the position. So I think that we will have a very strong competitive position in Sweden for many, many years because we have good people and a good culture, continuously working to improve our situation. Finland, small market, good quality start. We are on the map. It's not very important seen from a profit and loss point of view, but we are a truly Nordic organization and are of course very proud that the Insurance Broker Association nominated Protector to be the quality leader already in 2016. UK is ahead of schedule, so it's speeding up. You know we are prepared for 3.5 years, 1 year of analysis and studies, 1 year of deeper analysis and studies, collecting data, meeting brokers, then testing out the market in 2016 with the first handful of clients on board, and then now it is happening. We have more than 60 clients on risk April the 1st, including, as you know from before, Westminster, Chelsea, Kensington, Fulham, Hammersmith, and other boroughs in London. We do insure a third of London today. And we have a lot of clients around in the UK, both in public sector and gradually building up then relationship with the brokers in order to get in the right position to do more and more commercial clients. That will take time, but we have the first 10 clients or so on board and getting closer and learning. One of the sub-segments within the public sector is what you could call the housing sector. It's a property business area where around 80% of the business is property, short tail. It's rather low risk. It's reinsurance based. If a big fire arrives, the bill is passed to Munich Re, as always in that area. It's around a 3 billion Norwegian kroner market, so slightly below 300 million pounds. And as other segments in the public sector, there are basically 2 or at maximum 3 providers, carriers, competing in the market. And we are joining forces with a well-experienced broker with a long history in the segment that have picked Protector, and we have picked them in a joint cooperation in order to take a top 3 position in that market. Remember, one of the statements for Protector is to establish Protector as top 3 in any segment we enter. When we enter the housing segment in UK, dominated by Zurich Municipal with a market share above 50, we will go head on. We have a lower cost, a higher quality. We have the necessary underwriting skills. We can build databases and we can use our analytical approach to price these kind of large risks, but very distributed. So it could be 10,000 flats in a portfolio or 20,000 flats in a portfolio or even more. One client, one bill, distributed property portfolio. Low risk, high frequency. It's the whole market of Protector. This is a very interesting kind of area, and we do expect a lot of volume to arrive during the next 4 years. It takes around 4 years to turn a portfolio around. On average, a contract here will last for 4 years. Formally, it's a single-year contract, but it takes normally 4 years to turn around those 3 billion Norwegian kroner. And our target, market share target, is around 20. So we think that the market share size 20 after 4 years is reachable. But it's not very important to Protector whether it's 5, 10, 15, 20, 25 or 30. It must be profitable business here. But as a very interesting segment developing rather quickly at the moment. Do you have any questions to UK? Okay. So Denmark, the statement is back on track. However, the kind of figure you see here, the net combined ratio size 76.4, it looks brilliant. It looks great. It looks wow. It's not. Because we have a lot of reinsurance income in Q1 in Denmark. So you should focus more on that figure. A gross combined ratio, it's a more realistic view on the situation in Denmark. It's on the right side. It's slightly better than expected. It's only a quarter. Still, workmen's comp, the product, we had a lot of reserve losses last year, is not profitable at the moment. So that product is still unprofitable, but as expected. Because the kind of guiding we gave to you a quarter ago is that we don't expect to have a combined ratio on that product below 100 in 2017. It will not happen. On the other hand, we will keep the money for a number of years. So the return on investment, the float income side, is very significant related to this product. So you can live with a combined ratio slightly above 100. It's not a target, but it is today's reality. So still the claims ratio on that product is in the higher end. And basically, you could say that that product is unprofitable in Q1 2017. It must mean then that the other products are doing very well, which is good. Which means that price increases, throwing out clients, and new clients on board, especially in the public sector, is working. So we updated you a quarter ago that we had taken already profitability actions sized 80 to 100 million, everything else equal, that will lead us back to a good profitability in 2017. Our guiding is not a good profitability. We expect more problems to arrive. We haven't seen them in Q1, but they could still arrive. So I'm a bit on the conservative side still, not saying that everything is okay in Denmark, but it's a good start. And better than Norway, both on gross and net combined ratio in this quarter. And again, it's a small volume we have here, 150 million kroner earned premium every quarter. Obviously, it's volatility linked to it. But okay, a good start in Denmark. Don't expect too much growth from Denmark the next 3 quarters. So if growing with double digit again, that will at earliest be in 2018, could be in 2019. Do you feel more comfortable now? Okay. Just to remind you again, if you're taking a bit longer view on Protector, it's a story about cost leadership, quality leadership that should lead to profitable growth. So the DNA of the company have 4 main targets: cost and quality leadership should lead to profitable growth. Again, putting Protector in top 3 position in any segment we enter. So the final conclusion from Q1, we do progress according to those kind of targets. In Q1, not really in all areas, because claims level is in the higher end in some markets and product areas, but basically the long story is exactly the same. So when we're sitting investors in together with a couple of you the last days in the States and in Canada, it has been kind of a lot of interest in Protector, and that interest is linked to the long story. So no questions about kind of quarterly issues in Denmark or in change of ownership or in a certain product area. So they were focused about the long story, of course. And that obviously was only kind of the only story we could talk about when visiting investors in these days, so obviously, here. So I guess it's fair to say that we could expect some new owners to arrive from the States. At least good questions and good meetings. So the longer story, cost and quality leadership should lead to profitable growth. At the moment, it looks like it's working. Here's the figures, and also to remind ourselves that we do look upon investments as core business. The kind of investment portfolio, a lot of it is what Warren Buffett will call float. Money we borrow for free from clients in order to pay them out later. So the investment portfolio is getting closer to 10 billion Norwegian kroner. And if the growth continue, that kind of investment portfolio will obviously also continue to grow very rapidly. At the moment, we have allocated around 18% of that volume in an equity portfolio, and the rest in a fixed income portfolio. As you know very well, the equity team in Protector have done a good job or had a lot of luck, or both, during some quarters here. We all know that this will not continue, but what we still expect is that our portfolio will continue to deliver a good result in future. That's our expectation. The same with the fixed income portfolio, which continues to deliver a good return. At the same time, you can see that the yield, like any other fixed income portfolio in the world at the moment, is going down. So it's obviously a struggle in order to kind of have an acceptable return on the fixed income portfolio without taking too much risk. So if you know how to increase that and lower the risk at the same time, feel free to give me a piece of advice a bit later after this meeting. So I'm happy to listen to your secrets in that area. Rather challenging. But okay, nice market at the moment. It is. So equities is a bit behind benchmark in Q1, and honestly, I don't really care. It must be some kind of a volatility. We are not index-based, and we will not be. So we have 16 papers, and the underlying reality in that portfolio is what we could call very good. And it has only been kind of minor adjustments in that portfolio in Q1. You know that we, in the annual report, are updating you on the kind of papers we do have, and we will not do that on a quarterly basis. You could find out rather much if you follow Protector and looking into publicly available information, but that's more like up to you then in order to consider what kind of portfolio do we have, the kind of 16 companies we have where we are a part owner of the company then. A strong return in this quarter, sized 1.2, but the cost we are paying, as you understand very well, is that the yield is going down. A strong investment grade portfolio on average, today on a BBB plus type of level. So I at least I do have a kind of I believe in the company. I'm the chief executive in, and as you know, a big shareholder. And I got this as a present this morning from one of the employees. New cufflinks, is that the right phrase? Cufflinks? Cufflinks. Okay. I try to update my English a little bit then. As you know, the story I told when I bought some shares was that we do have an investment committee in my family with 2 people, me and my wife. We have to take, we have to vote 2-0 in order to take any decision. And an investment committee meeting in my family, it starts with one thing on the agenda every quarter, and it's me putting in an agenda. I suggest we buy shares. And the vote is normally 1-1. And then we can't buy. And then there is another kind of thing, number 2 on the agenda. It's coming from my wife. And she suggests we sell. And it's 1-1 again. And we continue to have these kind of meetings every quarter, and I had that for the last 6 to 8 years. This time, it was a 2-0 vote. I'm very satisfied that my wife finally arrived to the right conclusion. And this morning I got a present from one of the employees in Protector. It's stated here, buy low, sell high. So it's a piece of good advice to all of us then. Unfortunately, as you know, as a part of the investment committee discussion, I had to promise to sell exactly the same number of shares when share price reaches 100. Whether that is with or without dividend, that's not very clear. So it's up to me, I think, to decide and define whether it's with or without dividend. So, okay, at least I believe the story myself, as you understand. We are probably one of the most solid companies in the Nordic area. So after picking up more subordinated debt, which we feel is very cheap capital, we are now prepared for growth in 2019 and 2020. So we do absolutely not need that kind of money in 2017 or 2018, but picking up money in due time, very cheaply. You know the price. We will invest, turn us around and invest. So the cost after tax is extremely low. So as a shareholder, this is a nice move, and it continues to prepare Protector for further growth in 2019 and 2020. And again, the long story, it's about profitable growth on the technical side. And if we can manage to do that, then the investment income will benefit a lot to the return on equity of the company in future. You know that we have delivered return on equity size 24.5 as an average the last 10 years, or historical to date, the last 13 years. And the formal guiding is, as you know, a mid-long-term volume growth size 15 and return on equity size 20. That is the kind of formal guiding towards the market. So my final conclusion and summary is that, yes, it's a rather good quarter. Profitable growth continues. And UK is ahead of plan. Denmark is at the moment on track. There are some challenges on the claim side, so we have to watch carefully. We have to walk away from certain deals, and we have to increase prices in certain segments. But I think that we are capable of taking these kind of actions in future. The same team is on board, and I think that we should be competent to handle what we could call a normal competitive environment in our Nordic home market. And then it will take us 2-3 years in order to be absolutely sure what's happening in UK. Looks good at the moment. And then I guess we have some, Andreas, some questions.
I will see if anyone in the audience have any questions.
Please feel free. Last time I was a bit slow, so we were over time, and now we are 10 minutes before closing time. So
So we have a first question here from Jonas Dahlin. Float per share will soon motivate the whole market value for Protector. Any comments on that?
Looks like a good story. So, yes, I guess many of us agree that the value of the float situation is rather significant. It wasn't really a question, was it? It was more like a statement.
In Norwegian, kan du si noe om politikken bak reserveavsetninger? Hvor konservative er dere I disse avsetningene?
Okay, so what's your reserve policy? How conservative are you when it comes to reserve setting? I think it's fair to say that we are kind of rather neutral in what we are doing. So we're trying to put the reserves right. So we don't have a policy to over-reserve as a de facto standard in that area. So correct reserve setting is over kind of a policy. Basically, everybody should do that. But as you know, if there are good times, some companies are reserving too much, like Workmen's Comp reserve setting in the late 90s and through 2000 to 2010 in the Norwegian market. Whether that was conservative or not knowing the reality, it's debatable, of course. But our policy is to try to do it as correct as possible.
Is there any structural or legal reasons why the cost ratio of UK insurance is so much worse than in Scandinavia? Should we expect Protector UK to have a higher cost ratio than the company's Scandinavian operations?
Okay, so the cost ratio in UK might end up higher than in Scandinavia, and the reason why is that in certain segments, the commission level on the broker side is higher than what you see in Sweden and Finland. Commission are banned in Norway and Denmark, so not allowed. So everything else equal, cost level in UK will normally tend to be higher, especially in commercial sector. However, there is also a trend in UK that commissions level are going down and that more of the broker payment is done directly between the client and the broker. And commission level in public sector is on the lower end. It's only 3.5 percentage points. So it depends. Whether we will have a higher cost ratio than 7 in UK or not, it depends on the market and product mix in future. My expectation is that our cost ratio 3, 4, 5 years ahead in UK will be according to the Nordic cost ratio or lower. And if I should bet on higher or lower, I would put my money on lower. So I would expect us to be in the lower end, especially the first kind of 5 years before the commercial portfolio really starts to grow. But the important thing is not the absolute level, it's the real level between ourselves and competitors. As long as we are half the cost of competitors or possibly a third of the cost of competitors, it doesn't really matter whether we are 5, 7 or 9. Doesn't really matter.
Since the CEO has appeared very bullish on the value of the company versus the stock price lately, is there any special reason why stock buybacks have not been ramped up more?
Okay, so the board have some years ago decided to have a dividend policy, not a buyback policy. And you investors, you have normally a different view on it. Some like dividend, some like buybacks, and some like neither. Please reinvest the money in your own company. In the States, we meet more kind of requirements for buybacks, also for tax reasons, while many of you prefer dividend. We have also talked to most of you 20 biggest owners, and I think it's also fair to say that many of you would be very happy if we didn't pay any dividend or do any buybacks at all. As long as we can grow with 15 to 20% a year with a profit, both on the technical side and building a float portfolio, an investment portfolio, giving a lot of investment return as well, then we should probably consider to keep more money back. We cannot issue more subordinated debt the next 2-3 years. So now we are hitting the maximum. We have slightly more than we can put into play. So there will be a dividend discussion in the board during the next 6 months or so. So the chairman is sitting behind in the room here and nodding. We will have a dividend discussion then. Here, no buyback should be expected neither in 2017, and if something could arrive, that will be announced first as a policy change. So at the moment we have a dividend policy, we stick to it unless otherwise communicated.
Could you elaborate on what instruments are in the financial derivatives?
That is basically protector for currency losses on the fixed income portfolio. So it's absolutely no risk related to it. It is totally to protect currency fluctuations. So when sometimes investing in a currency which is outside the liabilities on the balance sheet, then we protect. And I'm looking a little bit behind in the room here to check out with the professionals whether I'm giving the right statement. And it was nodding, so thanks a lot.
Last question. Could you please elaborate on reinsurance pricing?
Reinsurance pricing is basically very attractive for a buyer like Protector today. And that market is expected to continue for the next 2 to 3 years. However, there is a new situation arriving in the UK. There is something called Ogden. And Ogden, the authorities in the UK, they have decided that the discount rate on long-term claims, it is changed to minus 0.75, which is driving long-tail claims upwards a lot. So big long-tail claims will now end up with a lot higher price. That has created the reserve losses in the UK market, and that means increased reinsurance prices. So there is one area which is challenging at the moment on the reinsurance side, that is on liability reinsurance UK, where Protector have 0 volume, but will have some volume in future. The good thing is that it has created reserve losses on the competitor side, meaning that they have more profitability issues than earlier, and the churn in the market will go up. So it is basically a good opportunity situation for Protector, the Ogden decision in UK. Reinsurance market soft, good for Protector. One issue, UK liability, some kind of difficulties, we can handle it.
That was it. That's all the questions. Anyone from the audience here?
Okay. Thanks a lot for meeting us again. Have a nice day, everybody.